It's time for the Money Puzzle Podcast. With good conversations and realistic solutions to the money puzzles we all face every day. I'm your host, financial advisor, chartered financial consultant, and president of Edgen Insurance and Financial, Robert Edgen. Now let's get this show started. Hello and welcome to the Money Puzzle Podcast. I am Robert Edgen and I'll be your guide for the ride for the next few minutes. Each week we look at a different piece of the money puzzle and practical ways to solve it so you can have the financial confidence you deserve and the future that you dream of. This is episode number 24 and today we are continuing on with the conversation we started last week about life insurance. Every September is Life Insurance Awareness Month, or LIAM as we call it in the industry, and we're celebrating by solving some of the money puzzles that center around life insurance. Now, last week we looked at two major types of life insurance to choose from. We talked about three different ways to figure out how much coverage you should have, and we talked about Robert's 3 rules for life insurance. We covered a lot, but we've still got a lot more great information to go through, and today we're talking about the different places or ways that you can get life insurance at work, through your banks or credit cards, or even the dreaded life insurance agent. Now, I promise most of us are not that bad, and some of us are actually a lot like normal people, but we'll talk about having conversations with agents. We'll also go over what the process is like to get life insurance set up and what you might expect to pay. What's that you say? How can we squeeze so much excitement into one show? Well, I know we're pushing the envelope here, but buckle up because we're going for it and I can't wait to get into that conversation. But before we do, I thought we'd take a minute and look at some news. All right, today's article comes from Reuters, and the headline reads, "Bad driving leads to $140 million drug bust in Sydney." A clumsy driver led police to a $140 million drug bust after he crashed a van with 600 pounds of methamphetamines into a patrol car parked outside of the police station in suburban Sydney. First off, I love the fact that an overwhelming amount of criminals seem to be stupid, because stupid people usually get caught doing bad things, and that's exactly how we get 600 pounds of methamphetamines off of the streets. But if you're the drug kingpin that's having 600 pounds of your product delivered across town, why are you using people to drive that are probably using your product when they're behind the wheel? Didn't any of these guys see The Mule with Clint Eastwood? That guy was the safest driver in America, and he still got caught delivering drugs. But putting idiots behind the wheel who pretty much deliver your illegal drugs to the police, the kingpins here obviously aren't businessmen, which I think is great. I actually love thinking about the head honchos kind of slapping their foreheads when they hear about meth head Mike, who was out for another delivery, and gosh dang it, Mike did it again. However it happened, I'm glad that it did. And if you'd like to read that story, I've got the link in the show notes. But for now, let's go ahead and get on to today's hot topic. All right, so you've decided you need some life insurance, and after listening to last week's episode, you know how much life insurance you need and what kind you should buy. On a side note, if you missed last week's episode and you do not know how much life insurance you need, this is a great time to pause it, go back and listen, and I promise I'll be right here waiting in the exact same spot when you come back. Okay, now that you know how much coverage you need, what do you do about it, and where do you get your shiny new life insurance? Well, there are other places that you can go to get the coverage besides just a life insurance company, and the first place to look for coverage is where you work. Does your employer offer life insurance as one of your employee benefits, and if so, how much coverage do you get? Now, personally, I love work life insurance because it's either free to you or so darn cheap you don't even realize that you're paying for it. If your employer offers life insurance in your benefits package, it's typically either equal to 1 year of your pay or a set dollar amount, say $100,000. So first off, do you count that as a part of your life insurance? So if you found out you need $500,000 of coverage and your employer provides $100,000 as a part of your benefits, does that count as a part of your life insurance? Absolutely. Now you only need to go out and find the other $400,000 of coverage. So employer coverage definitely counts as a part of your plan. But most employer life insurance is done through a group life insurance policy, which has a few characteristics that you should know. For example, even though you get to pick who your beneficiary is, who gets the money if you don't make it home from work, you do not own or control the policy. What do I mean by that? Well, it's not yours. It's like your company's health insurance. If you leave the company or you quit working there, you lose your health insurance coverage, and you also lose your company provided life insurance too. That means it's not portable. You cannot take it with you when you go. So if you've worked for a company for 10 years and then you move on to take a better opportunity, you're typically going to lose that life insurance that you were counting as a part of your plan. And now you've got to go figure out how to replace it. Now, maybe your next employer offers the same coverage or something similar, but if not, you're now 10 years older. And if your family still needs that life insurance coverage, you've got to go out and get it elsewhere while you are older. Does this mean that you shouldn't count your work life insurance as a part of your plan? Absolutely not. It's free coverage and it counts. But because of the non-portability of most work life insurance, it probably shouldn't be your only life insurance. Now, if it turns out that your employer coverage can go with you when you leave, that means it's portable, but that only happens about 5% of the time. If it does, you can expect the price to go up significantly from the free to almost free that you were paying, because now you have to cover the employer's portion as well. Now, a great benefit of a lot of employer life insurance plans is that there is limited to no underwriting. What does that mean? It means that it's very easy to qualify for coverage. A few years ago, I was working with an employer to provide life insurance for about 20 employees that they had. All of the employees just had to answer three health questions. They had to provide their height and weight and whether or not they used tobacco. As long as the three questions were answered no, they got that life insurance. Now, one of the employees, who happened to be the oldest employee in the company, he could qualify, and he did. Now, unfortunately, 18 months later, that employee died, and his work life insurance provided $100,000 to his family that they would not have been able to get had we been trying to get him a personal or privately owned life insurance policy. A lot of work life insurance has no underwriting at all, depending on how many employees the company has and how big the company is. So if you think that you might have a hard time qualifying for life insurance due to health reasons, which we'll actually talk about more in a minute, then work life insurance can be a great place to get that coverage for your family, or at least some of it, with limited or no health checks. Now, one of the times that you want to avoid your employer life insurance coverage, or just not count it as a part of your plan, is if it is accidental death and dismemberment coverage, or AD&D coverage for short. In fact, this type of coverage, no matter where you get it, really shouldn't be counted as a part of your life insurance coverage because of the extremely low probability of it ever paying out for your family. AD&D coverage gets offered up a lot from banks or credit unions, from your credit cards, or maybe the company that you got your car loan from. But this type of life insurance has a lot of rules and exclusions for things that are not covered. It's called accidental death coverage because it only covers deaths that happen to be from an accident, like a car crash or a plane crash. Now, I know what you might be thinking. A lot of people die in car and plane crashes, which is true, but only 5.4% of all deaths each year are considered accidental, according to the CDC. And even with a true accident, most AD&D policies place limitations on that as well. For example, what if you're in a car crash and it's a serious one, and then that results in you needing a surgery? And then during that surgery, you die of a complication. Well, a complication during surgery is not considered to be an accident, so there is no coverage under an AD&D policy. What if you survive the surgery but end up spending 2 weeks in the hospital and then get an infection or another complication and you pass away from that? That wasn't an accidental death either. The lifetime odds of dying in a car crash, which is the most typical accident covered under an accidental death policy, is about 1 in 112, according to nerdwallet.com, and I've got that link in the show notes. Any guesses to your lifetime odds of dying from any cause, whether it's an accident or a sickness or a disease? It's 1 in 1. It's 100%. So do yourself and do your family a favor and consider your accidental death coverage to be as a bonus bucket of money for your family if you happen to be one of the 5.4% of people who happens to go from an accident. AD&D policies typically look very cheap compared to most life insurance policies. For example, a 45-year-old male who does not use tobacco can get $500,000 of coverage, accidental death coverage, for about $20 a month. Now, $20 a month or less for a company to give your family $500,000 if you die tomorrow is pretty darn inexpensive. But it's cheap because of the very low odds of the policies ever having to pay anything out. Basically, you get what you pay for, and this is not one of those times where cheaper is better. So avoid accidental death policies or just don't rely on them as a part of your family's life insurance plan. All right, moving on. You can also get life insurance from companies that extend you credit, like your mortgage company or your car loan company, and that's called Credit Life because it pays off a specific line of credit that it is attached to. Now, your mortgage company may call it mortgage protection insurance, but it's the same things. These types of life insurance policies are just little term life insurance policies where the coverage actually goes down each year. However, the price stays the same. So the coverage kind of matches your loan or your mortgage and goes down, but again, the price stays the same. It's called a decreasing term life because the payout decreases each year. Mortgage protection policies actually cost about the same as a privately owned policy where the payout stays the same each year. That's called a level term life insurance policy. So it usually doesn't make much sense to buy coverage that goes down for the same price. Now, one other thing to know about credit protection life or mortgage protection policies is that the beneficiary is not chosen by you. You don't get to pick who gets the money. It's the car loan company or the mortgage company that gets it so that the loan gets paid off. Now, that probably sounds okay, but there are times when it's not best to pay off the house right away. What if the money is needed for other more urgent things? Or what if you've got a great rate on your mortgage or your spouse needs the tax breaks? There's no flexibility or control with mortgage protection insurance. Whenever possible, you want to buy coverage where you get to pick who gets the money if you don't make it home. Even if the intent is to pay off the mortgage, it's better if you get to choose to pay it off when it's best for your family to do so. So that's called mortgage protection or credit life. Moving on, if you're a senior over the age of 60, some companies will offer easy to qualify or guaranteed coverage policies for $5,000 or $10,000 to help cover funeral costs. The good news is that most people can qualify, but your premiums are still going to fluctuate based on your health and other medical conditions. So coverage for a very small policy can get to be pretty darn expensive. So those are the other places you can buy life insurance besides from a life insurance company, but really the only one that works well as a part of most financial plans is your work insurance, with the understanding that it could change or go away if you switch jobs. Whatever coverage isn't going to come from work is going to need to be purchased from an insurance company. So let's talk about what it looks like to go through that process of getting it set up. You can go through a bunch of online companies to get quotes for coverage, but there is real value in working with a life insurance professional. It's just like setting up your own will or fixing your own plumbing problems at the house. You can probably Google it and figure out how to get it done, but a professional is going to know things that you don't even know you should think about, and they're going to make sure that your coverage is set up properly to protect your family. Most of the life insurance professionals that I know take their responsibility very seriously, especially if you find one with some letters behind their name that and some type of industry designation that shows that they are serious about their craft and they take steps to further their education. A life insurance professional can help you decide how to structure your coverage for the best combination of price and coverage for your family. Maybe it makes sense to have some of your life insurance that lasts for 15 years and some for the rest of your life. A life insurance professional can help figure that out. And they can do the hard work of researching different companies and different coverage options for you. When you're talking to life insurance agents, there are a few important things to ask and find out. Do they have any professional designations that show additional education when it comes to life insurance? Some of the big ones are CHFC, CFP, or LACP. Are they members of any industry or professional organizations? A couple of the big ones for life insurance agents are NAIFA, which is the National Association of Insurance and Financial Advisors, or the FPA, which is the Financial Planning Association. You should also ask if they have any complaints or fines placed against them and if they're in good standing with their state's division of insurance. Now, you can also double check both of those things for yourself with your state's division of insurance. Since I live and work in Colorado, I included the link to the Colorado site in the show notes. That way you can see how it works, but whatever state you're in, you can Google it for that state and go check there. Now, if you're getting your life insurance, or at least some of it through an insurance company, kind of here's what you can expect to happen. First off, most insurance companies have a variety of ratings that you might qualify for. And those ratings determine the price that you pay for your life insurance coverage. They go from standard, which is for your average normal person with average health, all the way up to super preferred or preferred plus, depending on the company. And that's for your best health or your best risk people. There's usually about 3 to 4 ratings above the standard and about 6 to 8 ratings below the standard. That way the insurance company can give you the proper rate for your specific health and risk factors. So they're going to be asking you a lot of questions, and a lot of the time they're also going to request that you do a small physical or maybe a blood and urine check. The tests are looking for things like your blood pressure and cholesterol, might look for nicotine, check your kidney enzymes. A lot of them check for cocaine usage. And since we're in Colorado, let's talk about marijuana real quick. Insurance companies are going to ask you about marijuana usage. And from the way that I've seen most companies deal with it, it might keep you from getting the super preferred rating, or some companies may consider it the same as smoking, but I've not seen it disqualify anyone from getting life insurance, at least here in Colorado where marijuana is legal. Insurance companies need to know enough about you so that they can give you the best and most appropriate rate. So you'll also be asked about your medications, your sicknesses or illnesses that you either have now or have had in the past. You'll be asked a little bit about your parents and siblings, as well as your occupation, and your travel and any hobbies or activities that an insurance company might consider dangerous, like rock climbing or skydiving. Does this mean that you have to be a perfectly healthy, boring person who never leaves the house, never gets sick, and has parents that lived forever in order to qualify for life insurance? Not at all. I talk to people all the time who tell me they don't qualify for life insurance, but when I ask them who turned them down, most of the time they never even applied for coverage. They were just assuming that they couldn't get it. Now, we don't need to talk about what happens when you assume, but I will say that most people make the wrong assumptions when it comes to life insurance. There are so many people out there with high cholesterol or blood pressure, anxiety, thyroid issues, depression, arthritis. The list is virtually endless with all of the possible medical problems, but most of them do not disqualify you from getting life insurance coverage. I've even seen clients who have had a stroke or cancer in the past still get coverage. Now, that doesn't mean that everyone will qualify. Certain things will still make it very difficult to get coverage, like an ongoing medical condition that you are currently dealing with where maybe they don't know the cause or they don't know the solution yet, or a recent heart attack or a fight with cancer is going to cause some problems as well. But more people than you think can qualify. The best way to find out about your personal situation is to talk to a life insurance professional, tell them what you've got going on, get tested if that's required, and then find out for yourself. Insurance companies are probably also going to check your Medical Information Bureau report. That's a way for life insurance companies to get a small medical history on you right online without having to go to your doctor's office. They can also do a prescription check on you as well. So just be honest and upfront when you're filling out your application. It's worse to get caught providing wrong information than just explaining what you've got going on. All right, finishing up for this week, let's talk real quick about what you can expect to pay for your life insurance. Now, there's been all sorts of consumer research studies done, and for the most part, people think that life insurance costs way more than it does. For example, I've got a link in the show notes to one study which shows that 80% of consumers misjudge the price of life insurance. 80% is a lot of people that think life insurance costs more than it does. So what can you expect to pay? Well, there are actually too many variables for me to give you a specific answer for you, but here are some general rates for a preferred policy if you were to lock it in for 20 years at different ages in your life. For $500,000 of coverage locked in for 25 years, a 25-year-old male would pay about $27 a month, which doesn't seem very bad for $500,000 of coverage. If you wait until age 45, that monthly price jumps up to $61. And if you wait all the way to age 60, which is the latest age that you can buy a 20-year term policy, you'd pay about $260 per month. I know that sounds like a lot, but you're 60 years old and a 20-year policy is going to last you until you're 80, and a lot can happen between the ages of 60 and 80. For a woman who wants to buy that exact same $500,000 of coverage locked in for the same 20 years, they're going to pay less than their male counterparts because women have a longer lifespan. So at age 25, they'd only pay $21. At age 45, they'd pay $47. And if they wait till age 60, that price goes up to $186 per month. I've actually got a link to those samples in the show notes as well if you want to look at some other sample prices. All right, you're probably life insuranced out for this week, so we'll wrap it up with this. Buying life insurance is like buying a parachute. You have to buy it before you need it. Once you jump out of the plane without a chute, no amount of money or planning is going to help you or your family. So go check your coverage at work and see how much you've got. Then figure out how much extra that you need in order to protect your family and use this next week to go out and get it set up. The good news is that for the most part, once you spend the 30 minutes or so it will take to get it figured out and set up, you won't need to think about it again for years, if ever. And then both you and your family members can all sleep better at night knowing that if anything happened to any of you, the rest of you would be okay financially. Now, make sure that you join me next week when we go over a few more things about life insurance that you should know, like when it won't pay and how to have it pay out while you're still alive. I'll have my business amigo Brian in the studio with me for that episode, and I'm sure we'll have a bunch of fun together. But that's it for this week. So I hope you got some value from the show. If you did, please make sure that you share us with a friend who's been needing to add a little money sense into their lives. And please go give us a rating on whatever app you happen to use to listen to this podcast. Make sure you go watch us on YouTube, give us a thumbs up on that, and subscribe to the show so that you don't miss out on any episodes. Now, if you've got your own money puzzle that you need help with, email your questions to questions@yourmoneypuzzle.com. Until next week, be safe, have some fun, and do something to help solve your money puzzle. Your future self will thank you for it, and I'll talk to you again real soon.
Registered representative of and securities offered through Securities Management and Research, Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning, Inc. Edgen Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.